Chapter 2. What is a stock and how do you invest in it? A share of stock is a piece of company ownership. If a company is in good financial standing, they can issue to the public something called common stock shares to raise capital for the company itself. I'll use the term capital frequently in this program. This is synonymous to the term money. Then, once the company is offered shares as a member of the public, you can actually purchase a piece of ownership in these companies. Once you do, you've officially invested in a stock, and you are now a shareholder of that company and have a claim on their assets and earnings. This comes with tons of privileges, but think of yourself as an owner of the company you bought. I do, and that's exactly what you are. Why would a company offer stock? Companies will offer stock for tons of reasons. Some reasons include wanting to gain investment capital to start a new business or grow their business, investing in research and development for new and/or existing products, paying for outstanding debts or large outstanding purchase orders, or even paying existing shareholders a dividend can all be considered good reasons. What is a dividend? Dividends are awesome. One of my favorite advantages to investing in the stock market is the potential for recurring passive income. A dividend is a distribution of a portion of a company's earnings to its shareholders. This distribution can be in the form of cash payments, shares of stock, or other property. We'll discuss details on dividends later in this program. But for now, just know that this is a great way to make money passively while investing for growth. Passive income. If you're not familiar with the term passive income, today is your day. Passive income is the goal. It is the end-all goal. Passive income is money received on a regular basis with little to no effort involved. Humor me for a minute and close your eyes. Imagine what you would need to make a year to make your life awesome. Really think about it here. Let's say 6 figures, for example. The goal becomes $8,500 in passive income a month. Now, what that goal means is that you would need to be making 6 figures a year without lifting a finger, just letting your money work for you. Stocks can be a great part of increasing your passive income, and as you have more successes in the market, you'll have the ability to continue investing in stocks with good dividends that will pay you just to hold the stock. Investing for growth versus day trading. Throughout this program, you'll hear me speak frequently about investing for growth. What I mean by this is that we will be looking for stocks that show solid financial fundamentals, and will plan to hold every investment for a 1-year period. There are many reasons for this 1-year period holding, but this will be explained in detail later in this program. A different form of investing in the stock market is called day trading. This is when investors concern themselves with the second-by-second movement of their stock investments. We will not be covering this form of investing in this course, but it is important to know the difference, as when money is on the line, it is easy to make decisions based on emotions rather than fundamentals and research. By the end of this program, I plan to teach you how to learn confidence in the ups and downs of the stock market and help you learn to see through the small changes and instead understand why this is happening and remain focused on the 1-year calculated target. Trading on fundamentals, not fear. Being a great investor can at times be very similar to being a great skydiver. The key to remember is the training, research, and overall fundamentals. If a great skydiver let fear hold him back from jumping out of a plane, he wouldn't be anything more than a guy who rides in airplanes with the doors open. Being an investor is very similar. When hard-earned cash is on the line, it is easy to let emotions get the best of you. I'm here to tell you that if you do, you will be on a downhill slope to fear-based failure, and not just in the stock market, but likely in everything you do. We are going to reprogram your basic instincts. When we invest money, we're going to imagine that we spend it on something that doesn't generate income and it's gone for good. This will liberate your fear. You do have to commit to this, though. It is not something you can just say out loud. When you make an investment, I want you to truly believe that you will never see a penny of that investment again and be completely okay with that. A few reasons why. First, as a stock investor, your investments have the potential to go to zero. You should never leverage yourself so far that you have no escape if the market crashes. I had friends who invested in Bear Stearns in 2007. You may not be familiar with Bear Stearns, but it was a New York-based global investment bank and securities and tradings brokerage firm that completely failed as a result of the 2008 global financial crisis and recession. Bear Stearns hit its 10-year high on January 18, 2007. For some, it seemed like Bear Stearns would just keep climbing. Throughout the year, the stock declined to under $100 a share, which many people thought had huge upside potential. One day, I'm running on the treadmill watching CNBC Business News, and the word comes in that Bear Stearns is seemingly crashing. I kid you not, in the period of time it took me to finish my run, I watched the stock tank from $75 to next to nothing a share. JP Morgan ended up purchasing the company and its assets for $10 a share. Now, why am I sharing this story with you so early in the course? It's not meant at all to scare you away from investing in the stock market. Instead, it is to inform you and to strengthen your emotional core. Put yourself in some of my friends' shoes. Many of them sailed that ship into the ground and lost their entire investment. How would you feel? Defeated? Broken? Worthless? Dumb? Don't. Investing in the stock market is not easy, and there will surely be ups and downs throughout your trading career. But once you learn how to read the waves, you'll know how to surf them. In this course, we will focus heavily on training you before ever having to leverage a penny, preparing you to have a skin in the game. When you're ready to put real cash into the market, please don't invest money you cannot afford to lose. Nobody wants to lose, but it can be a reality, and I would not want you to be out of the game after one bad loss. You should be able to lose and still get back in over time. Until then, continue educating yourself, and I'll show you some tricks along the way for saving and growing your money to prepare for the real thing. A famous quote from Franklin D. Roosevelt that most of us know very well should give you comfort when you have doubts. The only thing we have to fear is fear itself. Assets versus liabilities. In this program, when we speak about assets and liabilities, we'll be adhering to Robert Kiyosaki's definitions. Kiyosaki is the author of the Rich Dad, Poor Dad series. If you haven't read Rich Dad, Poor Dad, it's very important to. To summarize his take, when we speak about an asset, we're referring to something that doesn't cost you money to hold on to, but rather increases your passive income. Let's take a new $30,000 car as an example. When you buy this new car from a dealership and drive it off the lot, your investment automatically depreciates, which means it loses value. If you sell it back to the dealership 1 minute later, you lost $2,500. In addition to the depreciation in value, you also are now making payments monthly for gas, oil changes, insurance, maintenance, and more. Now, this hasn't stopped people from buying cars. A car makes life easier. You can get places quickly, and that definitely has its advantages. However, from the rich dad's perspective, this would be considered a liability. Now, let's talk about something that does have the potential to generate income. A 3-bedroom, 2-bathroom, single-family home. Again, real estate investing is not something we will be covering in this course. However, for this example, we'll cover the concept briefly. The value of the building materials will likely depreciate, but the demand for your land and location could very well be something that increases over time. Although by banks, your home would be considered an asset, Kiyosaki would argue that it is not an asset because you are still paying monthly for property taxes, a potential mortgage, repairs, and more. This makes your investment no longer an asset, but instead a liability. The story would be different, however, if you take this same 3-bedroom, 2-bathroom home and you were to rent it out. If your income coming in is greater than your expenses month to month, you are now getting paid to hold the property. This gives you certainty over time. Holding your investment will not cost you, and you'll be able to freely sell the property if an improved property value shows itself. Now, you've got an asset. This same evaluation of property can be applied to stock investments. When looking for the right stocks, we will be evaluating so many different variables to each company. One item that we'll be looking closely at are dividends. Like I explained earlier, a dividend is a distribution of a portion of the company's earnings to its shareholders. This distribution can be in the form of cash payments, shares of stock, or other property. Dividends are one of the tricks that can really ensure high-quality, long-term investment. If a stock pays a dividend, they are actually paying you to hold each share of the stock. Like having a renter in your investment property, you are now getting paid to hold and still have the full potential for a capital gain when the time is right to sell. If you're not familiar with this term, a capital gain is a profit that results from a disposition of a capital assets, such as a stock, a bond, or real estate. Simply put, it's the income after the sale of an investment. Getting paid dividends to hold a stock for a long-term period increases its value as you can reinvest the dividends into more shares of stock, or you can collect passive income, which Robert Kiyosaki likes to call cash flow. We will continue to dig deeper into dividends and capital gains later in this program. But the important takeaway here is first, the big difference between an asset and a liability, and second, how your stocks can quickly turn into assets if you're able to collect a dividend from your investments while still targeting a capital gain end result.